People ask all the time what the real secret is to making money while you sleep. And here's the uncomfortable truth most people don't want to hear. There is no secret, no hack, no app, no button you press that turns effort into instant freedom. There is only sanity repeated long enough for time to turn it into wealth, and that answer sounds boring, which is exactly why so many people ignore it and keep chasing excitement instead. Modern investors have been sold a fantasy that passive income means downloading the right platform, following the right influencer, or jumping into the newest opportunity before everyone else. But what they're really chasing is magic, and magic has never existed in capitalism. Not in the dot-com era, not during real estate manias, not with crypto NFTs or automated side hustles, and not today. Even if the packaging looks sheenier and the promises sound smarter, every decade dresses speculation in new clothes, but it's always the same circus, and the same people pay admission. So let's be brutally clear, if someone is selling you a passive income system, their passive income is coming from you, not the system, because the people who actually earn passive income are too busy letting compounding work to sell courses about it. What actually works is disappointingly simple, and that simplicity is what makes it so hard for most people to follow, because you take money you don't need today, you invest it into productive assets that generate real cash flow, you reinvest what those assets produce, and then you leave it alone while time does the heavy lifting, which raises an uncomfortable question most people never ask themselves. Are you actually trying to build wealth, or are you just trying to feel busy? Real passive income isn't about constant action. It's about ownership. Whether that ownership shows up as dividends from businesses you own through index funds or ETFs, interest from bonds held appropriately for your risk tolerance, rental income from real estate that's structured to be sustainable, or long-term growth inside tax-advantaged accounts like a 401k, traditional IRA or Roth IRA, where the government literally incentivizes patience through tax deferral or tax-free growth. The irony is that building true passive income requires a lot of effort up front, because first you have to earn money, which isn't passive, then you have to spend less than you earn, which requires discipline in a culture that encourages consumption. Then you have to learn enough about investing to avoid obvious mistakes, and then comes the hardest part of all, which is doing nothing for years while everyone around you is constantly making moves. This is where most people fail, not because they're unintelligent, but because they're human, and humans are wired for novelty, action, and the illusion of control. So sitting still feels like falling behind even when it's the exact behavior that creates results. Ask yourself this honest lie. If you stopped touching your investments for 5 years, would you likely be richer or poorer, assuming normal market behavior and diversified holdings? Because that single question reveals whether you're building passive income or just running an active job disguised as investing. Real passive income shows up whether you're awake or asleep, healthy or sick, focused or distracted, like dividends that arrive regardless of your mood, rental income that shows up because contracts exist, or long-term compounding inside retirement accounts that grows even when you're busy living your life. A simple math example makes this painfully clear, because if you invest $500 a month into a low-cost index fund earning a hypothetical long-term average of 7% annually, after 30 years, you're not looking at 180 at well over 600,000, and after 40 years, it's closer to 1.3 million. Not because you were brilliant, but because you were consistent and patient. And that math gets even more powerful when those contributions happen automatically inside a 401 with an employer match or a Roth IRA, where qualified withdrawals can be tax-free. Yet modern investing advice often pushes people toward complexity, because complexity keeps people busy, and busy people trade more, and more trading means more fees, more taxes, and more friction working against compounding, which brings us to a truth that almost never gets emphasized enough. Fees matter more than most people realize. A 1% annual fee doesn't sound like much, but over 30 or 40 years, it can quietly consume hundreds of thousands of dollars of your potential wealth. Which means you're not paying for performance. You're paying for permission to underperform, and that's why so many long-term investors are better served by diversified, low-cost index funds that aim to capture market returns instead of trying to beat them. Consider a simple case example, because this isn't theoretical. Imagine two investors who each start with 100. One uses a low-cost index fund with a 0.5% expense ratio. The other uses actively managed products and advisory services costing 1% annually. Both earn the same gross market return over 35 years. But the first investor ends with hundreds of thousands more simply because less money leaked out through fees. And that gap has nothing to do with intelligence and everything to do with structure. The biggest mistake people make is confusing activity with progress. Because checking your portfolio daily, reacting to headlines, or constantly adjusting allocations doesn't create returns. It creates stress and taxes. And once you understand that owning stocks means owning pieces of real businesses, the daily price fluctuations become background noise instead of signals demanding action. Businesses that provide necessities like food, utilities, insurance, healthcare services, and everyday consumer goods tend to survive technological change because human needs don't disappear. And when those businesses are held through diversified funds, the goal isn't excitement. It's durability. This is why boring often wins. And here's an engagement question worth sitting with. Do you want investments that entertain you, or investments that support your future lifestyle? Another engagement question to consider is whether you're investing for headlines or for outcomes, because those two goals almost never align. Many people overestimate how much money they need for financial independence and underestimate how much control they have over the spending side of the equation. Because freedom isn't just about earning more, it's about keeping more, and lifestyle inflation is one of the biggest enemies of passive income. If your expenses rise every time your income rises, the finish line keeps moving. But if you can stabilize your lifestyle while your income grows, every extra dollar becomes a worker you can send out to compound on your behalf. This is especially important in the U.S., where taxes, healthcare costs, property taxes, insurance, and inflation all shape real purchasing power, which means smart planning includes understanding how Social Security fits into retirement income, how Medicare can reduce healthcare uncertainty after age 65, and how tax-efficient withdrawal strategies can stretch a portfolio further. Passive income isn't about avoiding risk entirely, it's about avoiding unnecessary risk, because market volatility isn't the same thing as permanent loss. And for long-term investors holding diversified assets, volatility is often the price of admission, not a reason to panic. History shows that people who sell during downturns often lock in losses and miss recoveries, while those who stay invested benefit when markets eventually normalize. Which leads to a third engagement question. Are you emotionally prepared to stick with a plan when it feels uncomfortable? Because that's when it matters most. The finance industry often benefits from making investing feel complicated, but the core principles remain remarkably simple. Spend less than you earn, invest the difference in productive assets, minimize unnecessary fees and taxes, diversify appropriately, and give compounding time to work. Passive income is not a product you buy, it's a behavior you adopt, reinforced by systems that reduce the need for constant decision-making, like automatic contributions, rebalancing schedules, and long-term asset allocation aligned with your goals and risk tolerance. This isn't about getting rich next year or even in 5 years, and there are no guarantees, but over decades, disciplined behavior combined with time can quietly produce results that feel surprising in hindsight. Real wealth often looks boring while it's being built, because the excitement usually belongs to speculation, not ownership. The people who win over the long run tend to do fewer things, not more, and they let arithmetic, not adrenaline, drive outcomes. The biggest risk to your financial future is rarely the market itself. It's your own impatience, your own ego, and your own tendency to interfere with a process that works best when left alone. So if you take one idea from this entire discussion, let it be this. Passive income is less about finding the perfect investment and more about removing yourself as the biggest obstacle to compounding. Live below your means. Use tools like a 401k match, Roth IRA contributions, and diversified index wisely. Respect taxes and fees. And then give your plan the one ingredient it can't succeed without, which is time. Quick disclaimer before we wrap up. This content is for educational purposes only, not financial advice. All investing involves risk, including loss of principal, and tax situations vary, so consider your personal circumstances and consult qualified professionals when needed. If this perspective helped you rethink passive income, subscribe for more clear, no hype US personal finance breakdowns. Comment the word BRING if you understand why boring beats exciting, and watch the next video on how to structure your 401k and IRA for long-term, low-stress growth. People keep asking what the real secret is to making money while you sleep, and the honest answer continues to disappoint almost everyone who hears it, because there is no secret, no shortcut, no hidden system, and no modern twist that suddenly overrides centuries of financial reality. There is only discipline repeated long enough for time, and compounding to do what they have always done. And the reason this answer frustrates people is because discipline is boring, patience is boring, and boredom doesn't sell in a world addicted to stimulation. The modern investor has been trained to believe that passive income means automation without effort, that you download the right app, follow the right influencer, make a few clever clicks, and then money appears while you sleep. But what they are really searching for is magic. And magic has never existed in capitalism. Not during land booms, not during dot-com manias, not during housing bubbles, and not during today's endless parade of side hustles, AI schemes, crypto promises, and hands-free income systems. Every generation believes it has discovered a smarter way to bypass the rules. Yet every generation eventually learns the same lesson the hard way, that wealth doesn't respond to excitement. It responds to consistency. Real passive income has never been about speed. It has always been about ownership, and ownership only works when it is allowed to compound uninterrupted. Here is the uncomfortable reality that most people never internalize. If someone is selling you a passive income system, their income is coming from selling the system, not from using it, because the people who actually earn passive income don't need to convince strangers online. They are too busy letting their capital quietly work. What actually works is painfully simple and emotionally difficult. You earn money through active effort. You spend less than you earn. You invest the difference into productive assets. And then you leave those assets alone for a very long time while reinvesting what they produce. That's it. That's the entire framework. But simplicity creates a psychological problem, because humans are wired to confuse motion with progress. So when nothing appears to be happening, they assume something must be wrong. Ask yourself honestly, does sitting still make you uncomfortable? Because if it does, investing will be emotionally challenging for you, even if it is intellectually simple. True passive income doesn't require your daily participation. It doesn't need you to check prices, react to headlines, or constantly optimize. It shows up whether you are paying attention or not, like dividends deposited automatically, retirement accounts growing in the background, or rental income arriving, because contracts exist, not because you woke up motivated that morning. In the U.S. context, the most reliable forms of passive income are often hidden in plain sight, such as consistent contributions to a 401k, especially when employer match is involved. Regular investments into a Roth IRA where qualified withdrawals can be tax-free, diversified exposure to index funds that own thousands of real businesses, and long-term planning that accounts for Social Security and Medicare rather than ignoring them, or assuming they won't exist at all. The irony is that building this kind of passivity requires intense activity up front, because you must work, you must budget, you must resist lifestyle inflation, you must understand basic investing principles, and you must structure your finances in a way that minimizes friction from taxes and fees. And then comes the hardest part, which is doing nothing while everyone else is constantly doing something. This is where most people self-destruct, not because they lack intelligence, but because they lack emotional restraint. People tinker, trade, rebalance excessively, chase trends, and slowly sabotage the only real advantage they had, which is time. Here's a simple math example that exposes how boring success actually is. If someone invests $400 per month into a diversified low-cost index fund earning a hypothetical long-term average of 7%, after 25 years that person ends up with roughly $100. After 35 years it becomes over $650, and after 45 years it pushes past $1.2 million. Not because they discovered anything clever, but because they stayed consistent while others got distracted. Now compare that to someone who constantly jumps strategies, pays higher fees, triggers unnecessary taxes, and periodically panics during downturns. And you'll often find the second person worked harder, felt busier, and ended with less. This brings us to one of the most damaging yet least discussed enemies of passive income, fees, because small percentages compound against you just as powerfully as